Good afternoon, and you're joined us today with EFM, and we're going to be speaking about something that's very topical at the moment, which is all about forecasting. In the current climate, we feel at the moment, everybody and businesses have gone through dramatic changes. And in some instances, people have to readjust forecasts and almost create new forecasts. So the whole crisis management part of what BITA has been doing on the online platform has dealt very well with certain topics in this area. And I'm delighted to be joined today by Gary Jesson, the Managing Director of EFM, and also the Financial Director, Malcolm Holloway. So I will hand it over to you boys to give us a more insightful view into forecasting, please.
Thanks, Paul. Yeah, thanks, Paul.
So the way we want to do this today is that we don't want to just do a flat presentation. So we've not got any slides, although there are some slides that we can circulate afterwards. We're going to do it as a bit of a Q&A between Gary and myself, just to see if we can cover some topics that might be of interest. We are very keen if you've got any answers or any queries on either what we're saying or something we're not saying, put them through on the chat or the Q&A and we'll try and get to them as well. So I'm going to start off by asking Gary, so Gary, why do you think forecasts are important?
Forecasts for any business are always important, and you'd expect a finance person to say that. But yeah, they arrange, for a number of reasons, really. You should be looking at forecasting and planning as a regular routine. Whether it's setting prices, whether it's setting budgets, whether it's working out, your buying costs, what to pay people. Every business should do that as a regular discipline. Clearly also there's a lot of businesses at the moment running around looking for cash, looking for funding. And almost certainly every funder is going to want a forecast of some sort to prove or prove as best you can that you have the ability to repay the funding that you're asking for. And I think the bit that's really changed and more important, and lots of companies don't do at the moment, is really this short-term forecasting. The world is moving at a rapid pace. Particularly if you're an online business, things are changing very fast. Unfortunately, there are businesses that are struggling. And interestingly, businesses are doing incredibly well. I've just come off a phone with a business that's gone from 10 million to many hundreds of millions revenue on the back of this. Right place, right time. But that also requires forecasting. And the minimum, people should be looking, 2-3 months ahead, rolling basis, picking up, what could go wrong. And being prepared, because you can't turn on the tap for money as quick as you'd like if there's a problem at the moment.
Okay, so your views have obviously changed since COVID-19. Are there any sort of other areas that you've more talked about the short-term nature of the whole pandemic?
Yeah, I think it's interesting when people talk about forecasting. They often sort of just think about numbers, but in reality, good forecasts at the moment need a lot of operational insight. So a fantastic example is things like the social distancing rule. We're doing a lot of work with Enterprise Ireland for any of the Irish companies on the call, and they're allowing companies to get financial planning grants. And one of the ones we were working on was a restaurant business in Dublin, and 2 metre versus 1 metre made a massive difference between that business being loss making and at least breaking even. And normally, things like that are not just factored into a forecast at all. So non-financial data, I think, becomes completely relevant now and relevant to the circumstances of what's going on at this point in time. I think the other thing that's quite relevant is there are so many companies have deferred or put tax liabilities to the side. I think in Ireland they talk about warehousing their tax liabilities. In the UK, they're deferrals. And they are deferrals. They are not grants, not yet anyway. And therefore, the forecast and the plans need to think about how those things are going to be repaid sometime in the future. So it's that intensity and that level of detail, and probably going from monthly to weekly, daily forecasts, I think are completely relevant at the moment. So an ever-changing world, it needs everyone's input. The business owner. This isn't just the realm of the finance team. It's the business owners and the people on the call that know what's going on and should be feeding that in. So yes, forecasting is important. Yes, it's changing. And yes, you really need to keep on top of it more than ever. And I guess from my perspective, I do a lot of these, as do you, Malcolm. So it'd be quite useful for you to share what you think makes a good forecast.
Okay. So I'm going to sort of concentrate on a couple of types of forecasts. So there are various different types of forecasts for different needs. Gary's talked about the short-term forecasts, some sort of rolling 12, 16, 18-week forecast. So you've got a view on what the cash is looking like. So the short-term forecasts are all about cash, where it's going, when it's coming in, probably on a weekly basis. You could do it daily if you've really got the time, but at least on a weekly basis to understand where the ebbs and flows, because in any month, the months have variances within them. So the short-term forecast is all about cash movements and understanding where your headroom and other bits are. The more traditional forecasts, which are the sort of forecasts that you might use to support a loan or look in the longer term, there's some fairly sort of common rules that you need to do about them. For a start, they should contain all the proper elements that a forecast needs, and that's a trading account. So that sort of shows on a month-by-month basis whether the business is going to make any money, what its costs are, what its direct costs are, what its operational costs are, and it shows the profit and loss. You then need a balance sheet, and a balance sheet is key because that shows how the whole thing pulls together. So that will show what your debtors are at any time, what your monies owed out are at any time. So it needs to have a balance sheet. And of course, linking those, it needs a cash bridge. So we need to see how we get from the trading account to the balance sheet. Because just because you make a sale in, say, July 2020, doesn't mean necessarily the cash for that sale is going to hit July 2020. You know, sometimes businesses operate on a cash basis, in which case the sales number in a trading account is the cash number. But for most businesses, it's not. And therefore, understanding how the cash moves from your trading account to your bank account is key. And therefore, an integrated model that sort of starts with a trading position, shows how the cash movement works, and an end balance sheet is key. And particularly anyone of a third-party nature looking at this is going to want to see that. They're not just going to want to see a trading account or a cash flow or a balance sheet. They want a model that links the whole thing together. Now, there's some sort of fairly fundamental things as well that you need. So you need to make it easy to read. Most forecasts are normally shared around an organization. So simple things like if you're using an Excel spreadsheet and you've got multiple tabs, certainly have summaries that fit onto an A4 sheet of paper. There's still a lot of people who like to print off forecasts and sit and write with them. So make sure they print easily. Make sure that you can put them up. So if we were doing this on a screen or on a Zoom call with a management team, you want to put something up on the screen that everyone can read. So keeping it simple. Now, if there's lots of detail behind it, that's fine. Have it in ancillary tabs, but have some sort of summary tabs that enable you to very clearly display the information, either on a screen or on a larger wall panel, or even if necessary, if people want to print it out. They should be sensible. You know, the aim of a forecast is to look at a realistic set of scenarios. So there should always be at least a page of assumptions. We are going to assume that our customers are going to pay us in 30 days. We're going to assume that we're going to take credit from our suppliers of 60 days. We're going to assume that we have 6 members of staff. So a page of assumptions that underpins the model is a key requirement so that anyone picking up the model can understand on what basis that forecast has been put together. And I suppose the other key component, what I quite like to do if I'm doing modeling, and it normally goes down well with either the clients who I work for or potential lenders who are using them, is to have some sort of sensitivity analysis built into the model. So it might be as simple as, when you've got a sales line, just adding a formula that says if the sales are 50%, what impact does it make? So you can just put in a highlight box in the assumptions tab, 50%, and because it's an integrated model, it just does all the sums. So you can quickly and easily run a number of scenarios that say, if we hit 75% of budget, what does it look like? If we hit 110%, what does it look like? Or if our debtors take 2 months to pay, what does it look like? So I think there's so the bits about the fundamentals of how you build a model are important. So it needs to be integrated from profit and loss through to balance sheet with a cash bridge. It needs to be simple, that people can see it in the summary format, at least on a sheet, on a screen. It needs to have assumptions so that everyone knows what underpins the model. And it also needs easily to be able to be sensitized. You know, what happens if? So they're, to me, the components of a good model.
Thanks, Malcolm. And yeah, it's interesting when you look at it and some of the things going on, and particularly the government reliefs at the moment and the banking reliefs. It's interesting. I'm seeing, I'll ask for your views as well, but the different funders, all need some of this stuff, but some don't always need it as intense. It's quite interesting how they're approaching this. I was looking at a company with one of our associates this week, and we just knew the bank would turn it down because it was poor. It didn't have any of the things that Malcolm said. The bank really just need to get their head around whether you can afford to repay this loan. But then equally, we've seen other funders, maybe Funding Circle, keep to their sort of standard online application process and send them bank statements, and then they'll make a judgment. So it sort of suggests you don't necessarily always need the forecast, to get through maybe some funders, but you do need it internally to manage the business. Malcolm, you sort of seeing similar things with funders and actually VCs to banks. Do they vary?
Yes, they do. And I think this goes to the heart of understanding what the forecast is for, which is where we sort of started the conversation, that every business needs a short-term cash forecast. That's operational. It's on a week-by-week or a day-by-day basis to actually demonstrate what's going to happen to the cash over a number of short-term scenarios to make sure you've got no nasty surprises. The management need to know that and understand that. And I'll give an example of that in a minute. But also, a lot of funders, so not necessarily the banks, but if you've got institutional equity funders, a venture capitalist, or you might have an angel investor or a PE house, they need to know that they're not suddenly going to get a call from you on a Friday night to say, I've not got enough cash to pay the wages next week. They need to understand that in the short to medium term, and that's probably 3 months, the business has or hasn't got enough cash. So there's no nasty surprises. Building onto that sort of more sort of longer term. So if you are looking to raise more funding, then the short-term funding is important, but it isn't the key critical bit. The key critical bit then becomes the longer term viability. And therefore you can start to look, rather than the absolute detail on a week by week, you can actually take a view as to, on a month by month basis, what does this business look like, particularly in the next 6 to 9 to 12 to 15 months. So it's about then looking at that longer term viability, and it's about making sure that all of the balls are covered. Gary mentioned about debt. So one of the things that I'm building into my forecast at the moment is a separate line in the cash flow to show debt catch up from HMRC. Traditionally, that would have just been a standard line in a forecast, payments to HMRC, and they would have been monthly in line with what was expected. I think it's important now that you start to highlight the fact that you are building up debt and when it's going to be repaid. You can look at it on a 2 to 3 year basis, because in reality, come December, a lot of this debt's going to start falling due. The government's been very sort of generous, certainly in the UK, about deferring PAYE and NIC liabilities and VAT, but it is going to fall. And I think a lot of businesses are going to have a nasty surprise come December, January, when they realise how much debt they've actually run up with the government. So indicating how that debt falls is really important.
It's interesting on time to pay. It's quite interesting. I think there's this sort of a myth that if you've agreed a deferral on PAYE, you will just get a period to pay it off. That isn't the case. You're expected to call HMRC and agree a period over which to pay that debt. And that's very different to that, which has to just be repaid by 31st of March next year. And you would be, I guess, foolish and unwise to not have some sort of cash forecast to go to HMRC and try and arrange a time to pay, because it all gets a bit difficult and messy if you default on a plan.
It's quite interesting. We're actually starting for the first time to see default letters come out from the revenue now, even for people who have phoned up. So one of the advice we've been given is that trying to get hold of the revenue has been quite tricky over this period, although they're getting better. But if you use the web chat on the revenue website, you can actually print out the web chat to show that you've had a conversation and agreed to defer. And that gives you a bit of evidence. If at some point the revenue come back and say, we had no idea you had agreed to do this. But we are beginning to see default letters come out now. The revenue seem to have sort of stopped the period of grace and are now beginning to sort of chase people who they were expecting payments from and haven't heard from them.
Yeah, and that's why it's important. It's about who prepares this, because it does need everyone's input. It may be the default letter's actually gone to your accountant, and someone hasn't picked that up. It may be that you've taken, Malcolm's point, you've taken a view that customers will pay you in 60 days. But the head of sales or the sales director has actually done a 90-day deal on a big customer, and you haven't got that in your forecast. And suddenly you've got a big hole. It may be the ops director comes in and says, "Yeah, we just won this big contract. We need to buy all these materials," and you're having to spend money substantially before you collect the money back. So you have this working capital hole. Because actually one of the tricky bits when you're on top of this, actually, and particularly relevant now as we come out of post-lockdown world, is a lot of companies will go bust, and they'll go bust not because they're a good business, a bad business. They'll go bust because they can't collect their money from customers as quick as they're having to pay it out to suppliers and staff. And again, that forecast needs to show that and demonstrate that to funders, the board or whoever's using that data. And it needs to cover everything. And I guess a few tips from me, and I'll ask for a few tips from Malcolm. But the things that sort of people get wrong, it's those sort of things where other people in the business have done deals and you don't know about it as the forecast preparer. It's what I call the lumpy items. It's deposits, or it's retentions that are on building contracts. Groundworks. You've forecast 100% cash, but the sub is only going to take 95%, or the main contractor is going to pay you 95%. It's things like VAT. How many forecasts do we see where people think 100% of sales is their own cash, but in reality that money's going out to customs and excise. So there's a number of things that go wrong, and hints and tips for me is just making sure lots of eyes over it, making sure you've covered all the angles, and more importantly, the person who does it is not the person who necessarily steps back and has a bit of a sense check. I recall looking at a forecast recently. The business was making, I think it was about £500,000-600,000, but in a year their cash balance went up by 3 million. And that just didn't make any sense at all. And it was all because they treated VAT almost as profit rather than cash flow and not their money.
It's interesting, Gary. Yeah. So who do you think should take responsibility for forecasts? Because someone's got to own it, because if they don't, it'll just sort of fall between too many people.
Yeah, no, my view, it's the MD, it's the owner of the business. It should be the whole board, but in a lot of SMEs, it's the one or two people. This isn't something you just sub out to your accountant or to your bookkeeper to do. It's very much the management, the board, and ultimately the person at the top of the chain, because they're making the decisions.
Yeah, and I think that's probably, it's all about that sensibleness, but someone's got to own it, and it shouldn't necessarily be the finance person. The finance person might be responsible for preparing it, but a good forecast is one that anyone in the management team understands. So part of the role of a good finance person with a set of forecasts is making sure that the whole of the management team understand how it's put together and how to operate it. Because the points Gary made about, if you've got the sales director sitting there saying, the finance director saying, well, we've always collected 30 days, so therefore we'll always have 30 days. If the sales director has told his sales team that they can give 10% discounts if people pay a bit longer or faster, that needs to be fed in, and sometimes that route isn't clear. Yeah. So therefore, having that ownership across the management team and a sense check, the second point that is really important is that everyone who has a senior input, and whether that's on production, whether that's on sales, whether that's on marketing, has had a chance to look at the numbers and is happy with them. And that might just be an individual sign-off. Are you happy with the sign-off? So a good example of that, I've got a business that's based up here in Northumberland that manufactures internet connectivity units for building construction sites. Now, they've been quite lucky because the building construction sites have kept going over the lockdown. So they've not seen the massive drop-off on their sales that they might have expected. But what they've got the problem now is that in order to start to build their sales, they need to have new construction sites coming in. Now, the difficulty is those units have to come from Germany. So there's a 3-month delay in ordering those units. So their big challenge at the moment in their forecasting is anticipating when the construction sites will come online, because they can't just say, oh, the construction sites are open now, I want 3 units. They've got a 3-month delay before they can supply those. In order to get them, they have to pay half the money up front. So they can't just order a whole stack ready to go. So it's quite a tricky equation. And therefore the forecasts have had a lot of time, unusually, between the production director, the supplier in Germany. So we've engaged with the supplier in Germany to understand what their timescales are like, because pre-COVID it was 3 months. Actually, they're saying it might now be 4 or 5, because we don't know when we're going to be open, or, you know, Germany's had some interesting temporary shutdowns. And you sort of then match that across the world with people with supply chains out to the Middle East and the Far East. And actually, as important as the money coming in, is the money going out?
Yeah, it's an interesting one, because I had a sort of similar one, an online ladies fashion business. What do I know about that? But they hit all the forecasts were done on a growth basis. Originally the budget, the plan. Very early on, they hit a huge, exactly Malcolm's point, a huge supply issue, because a lot of their product was coming in from overseas, and all the factories shut down, and so they had a huge supply chain issue. They were having to sort of sell stock. And then as they got into this, they suddenly got into a supply position where they could actually do face masks. Never supplied face masks in their life, and it's absolutely gone bananas. Right? And there's nothing in their forecast for face masks and how to do that. And not only then was it modelling that in, unbeknown to the finance person who was doing the work, the lady who runs the business said, "Oh, for every face mask we sell, we're going to give a couple of pounds to charity." And suddenly a percentage of the revenue wasn't theirs anymore. It had to be ring fenced for another business. So again, those forecasts had to change dynamically, regularly, and quickly to deal with a very different position as the business unfolded. And we're seeing that across many sectors. Another good example. One of our businesses is a bicycle distribution business. They are flying, literally off the shelves at the moment. They have more bicycles, they're selling more cash, record months every month. Their problem is, come July, they won't have any stock left. And exactly Malcolm's point earlier, they're on a 6 to 9 month lead time. So they're going from, heyday banking lots of cash to actually they're going to now need to reforecast to make it last, because sales are going to be a trickle for 6 months. And I think just a couple of examples of how things dynamically are changing, why you need to be doing this regularly. It isn't about producing a spreadsheet by the finance person and put it on the shelf. These are real cash management business tools to keep your business alive and deal with the uncertainty, the cash shock. Bearing in mind, we've still got talks about second waves, and also the B word that we've all sort of forgotten about for a while, but Brexit. Is going to come back into play and impact companies bitter that are both on the Irish side and the UK side of the border later on this year and early next year.
So Ronnie's raised an interesting question, which is, we've gone through a very interesting period, although it's been a bit more rocky with the Brexit, the B word, prior to COVID, but actually currency translations effects are beginning to become more major. If you look at, I've got a client that gets a lot of its sales in dollars from the States. It's had a massive impact. The dollar in the last month alone has been from, I think it's 117 up to about 126. That's almost 10% swing in the value of their sales just for currency movements. We haven't had an environment like that for a long while. So forecasting for them has become important. When it went through down to 117, they gained hugely. Their sales are up 10%. For doing nothing, just because of the strength of the pound v the dollar. It's gone the other way now, and therefore it's really important that some of those external levers that we've probably just taken for granted, that we've been in a stable position. If you look at the pound euro, it's been relatively stable. But Ronnie's right, foreign currency translation and currency exchange rates are going to become a key part of forecasting moving forward?
So on that moment, on that point there, what is a specific, a company that is going to experience those fluctuations? What is the safeguard that they can put in terms of a percentage swing either way? What way should we be thinking in that regard?
I think it goes back to 2 points, Paul. The first thing is I think you need to set out in your assumptions what you're going to assume. So anyone reading the forecast knows, that we are assuming there will be no currency fluctuation, or we are assuming that the pound euro will be at 115 or whatever. So you need to but then you also, this goes to the sensitivity point, that you need to be able to flex it. Plus or minus 10%, I think is relatively prudent. If you're going to get into a position where it's going to be 10, 15, 20%, then we're in a whole new world and things will change. So I think, probably doing 5 to 10% is a sensible, let's just have a look, see, and make sure we know how that goes.
Yeah.
If it is that key critical, and if it is a big enough number that actually even a 5% swing makes your forecast unviable, then you need to look at other strategies to mitigate that. And Ronnie's just put one, you can hedge currency. You can buy forward. There are ways around it. So the first thing is understanding how critical is a 5 or 10% movement in the currency, and then if it is critical, what can I do to mitigate it? If it's difficult but manageable, then you might not want to put a mitigation strategy in place, but you need to at least have considered it.
Yeah,
in terms of hedging currencies, then I know Money Corp is one example of a great sponsor of the ITA. So in terms of the hedging that's available, what kind of hedging is available in terms of duration?
I think there's a couple of ways of looking at it, Paul. There's something sometimes what we call an internal hedge. So one of the companies we're working with within Ireland, they buy predominantly from China in dollars. They were predominantly selling in Europe, but now are selling in America and selling quite well in America. And they do children's toys. So very seasonal as well. So if the rate goes wrong in November, December, it can impact them massively. So they've got what we call an internal hedge because they're buying in dollars and selling in dollars. So they're only exposed on their margin. The other option then is talk to the money corps, the financial institutions, and those things can range from long-term contracts, year to short-term, or just quantums of money. So we work with some companies that said, look, I want to buy X million euros and locks that rate in today because their forecast has said, look, we expect to trade 2 million's worth of euros in the next 12 months. So I'm just going to lock that price in now. And that can also then become more or less sophisticated with more complex instruments. And that's where I would recommend you have a finance brain around the time, because you can have all sorts of options to let you cancel the currency transaction, do it at different rates, and very complex areas. And I'm sure Money Corp guys can explain that. But
and the cost is obviously very, the cost is based on the risk. So therefore, the longer out you go, depending on the more risk there is, the higher it's going to cost you. But it is important that you understand from someone who does know that, and whether it's Money Corp or whoever, that you do understand the cost of that, because it's not just as simple as saying I'll do it, because the cost actually might be worse than actually taking the risk. But it's like all things, forecasting is about understanding where the risk is, what's the mitigation strategy, because all of us should probably have a lot more life insurance cover than we've got, but we do a risk against what it's cost about, where, and I think you have to do a similar thing with an exercise. And if you've got a sensible enough, well-prepared set of forecasts, you can look at those, run those various scenarios. The nightmare scenario, you can't really forecast against.
Yeah, I think the point, Paul, on that is that if you're using your forecast to go and talk to a funder, you probably need to assume they're going to know more about that than you in terms of the currency markets. And if you've put a 5% sensitivity and they reject you, you probably know your sensitivity might be wrong. They're not always right. Don't get me wrong, but I think you're more likely to get a good hearing and consideration if you've taken some hedging policy rather than floating, particularly in the current market. And it's not just currency, but currency is one of the big volatile things that can make or break a business in the current market. Anything else you're seeing from your members, Paul?
Well, there's one or two questions here in terms of the prospect of stimulus grants appearing to stimulate performance. For people now, for instance, are holding back certain funds in certain areas. Let's take a hypothetical situation of a domestic situation where you decide, I'm going to reduce my mortgage. And the very moment you reduce it, there's a government stimulus that comes into place and you miss out on that. So, what can you see, or what do you see on the horizon in terms of stimulus packages that will have to be put in place to stimulate performance?
Oh, okay, good question. I'll have a go. I'll let Malcolm have a go as well.
Yeah,
So,
I'll have a go.
so what our advice generally is, if you can get these reliefs, take them, because this whole idea of we don't know what tomorrow is going to bring, and so actually take something now is probably better than waiting. What we're hearing is, clearly, UK PLC and probably Irish PLC, balance sheets are going to be stacked with debt, deferrals and debts. And there is it's certainly talk in the UK of a banking setup not dissimilar to the Northern Rock scenario with all the bag mortgages, picking your point specifically, Paul. We suspect and we think, and we're seeing a bit of traction now around possibly sometime in 21 or later, a bad bank scenario where unpaid bounce back loans or CBIL loans will get pulled into this bad bank to collect out. And whether some of that will be written off or whether some of that will be just paid over a lifetime, bit like a student loan, is yet to be seen. But I think there's no doubt on the sheer quantum of what's going on, there's going to need to be some sort of support mechanism across most countries of the world. But I don't think we quite know the shape of that. And I'll pass to Malcolm, but the point on that is, if you are taking debt on, you as directors are responsible for paying it. Right? The government is not guaranteeing the debt to you, they are guaranteeing the debt to the bank. So again, my point there is, don't take it if you don't think you can afford it, because you are potentially creating a problem for yourself and a breach of your company's Act regulations. Malcolm.
Yeah, and I suppose I agree with everything Gary said. I sort of take a slightly different view. It depends on where you're going for your debt and what you're doing. So in the UK, the bounce back loan scheme was almost an easy in, easy out scenario. It was a simple deal. It was relatively painless. It wasn't a large amount of money, and there wasn't a lot of hassle. But on the other hand, if you'd have started at day one of the lockdown, everyone thought CBILS was the right answer and spent a lot of time finding out they couldn't get a CBILS loan because of the viability test. But by waiting 4 or 5 weeks, when the government realized it wasn't working, something better came along and you could have saved a lot of time. So there is one school of thought that says, if you're not absolutely desperate for the money in the short to medium term, the government is still going to have to do something. Something better might come along. They're not going to take away these other schemes, but hanging on a little bit. And I'll give you an example of that, which actually worked well with a lender. I've got a tech business that relies on a lot of digital scanning and virtual reality stuff, and they need to do quite a lot of that on site. And of course, when COVID came along, that stopped. So the immediate thought was, we'll go back to the venture capital fund and ask for some money. But before we did that, we did all the basic steps that you should do, which is we prepared a short-term forecast. We looked at what other government help was available with furlough, with things like the bounce back loan, and we put ourselves in a position where we knew that for 3 months that we were okay. We knew we would need money in the longer term as this got worse, but we didn't really quite know how much that was. But by doing the short-term forecast to show that we actually had 3 or 4 months runway before we needed to do something, we were able to engage with our debt lender to say, we will need to come to you. We will need some money, but rather than knee-jerk now and ask you for an amount that we're not sure what it is, if we start an early conversation with you, knowing that we're not going to need it for 3 or 4 months, can you put us into a queue line ready for when we do know what it is in 3 or 4 months' time? And the positive response we got from that was absolutely tremendous. The one was, well done, guys, you've looked at it, you understand, you haven't just picked up the phone to us and said we need more money. Secondly, you've identified when the gap is likely to appear. But thirdly, you've taken a problem off our desk while we deal with all these nightmare short-term problems, that we know that in 3 months' time you'll need something. We can allocate you something then, and we can deal with it then. And we're now sort of 2 months into that journey, and we actually had, it's a venture capital fund, we had a board meeting on Tuesday, and they are now pushing us to put a funding request in, because they've dealt with all their short-term problems, and we're probably going to, we've got a lot of kudos from not knee-jerking, but waiting and doing it well. And by doing that short-term forecast, the longer-term forecast showed that we needed it, but by doing the short-term forecast that said we can survive for 3 or 4 months, we were able to give the lender a bit of comfort that we knew what we were doing, and he's now pushing us to understand how much we want. And I'm not saying it's an open door, because it never is with a lender, but I've never had such encouraging noises. Yeah, you can, because they trust what the management team's doing.
Yeah, that's a good point, Mark. I think the other thing, Paul, just to point out, CBILS is still open to, I think, the 30th of September, and Bounce Back, I think, is to the 4th of November.
Yeah.
And outside that, there are all the lenders that are doing all the traditional stuff still. Right, yeah. So everyone's focused on those two types of funding, but there are lots of classic growth tools, invoice finance tools, stock finance tools that are available, and lenders generally have money and they need to make money by lending. So lots of opportunity if you're properly prepared and you have forecasts and things to show you that you can refund it.
So EFM is relevant and unique in this point in terms of it's relevant to UK and Ireland. And we have quite a lot of small businesses who've joined BITA and are looking to kind of, stimulate their business by coming into a new market in the UK. In terms of the small businesses, how small a business can utilize and can they utilize EMF or EFM for specific areas like forecasting, for instance? And if so, how do they get involved with you and contact you?
Yeah, look, Paul, we work with anyone from as little as an hour a month sort of thing. It's very much tailored the support around what they need. And if we can help them, we will help them. You'll have our details through Laura at BITA. We're in the members directory, and there'll be we have some slides we can send out, and they'll be on that as well. But it's about, I guess our philosophy is we'd rather you pick up the phone and talk to us. We're not going to charge you for the phone call. And then on that phone call, we'll either make an assessment with you whether we can help or not, or if we can't, we'll signpost you to somewhere else. Because we'd much rather help you and get it right than have to dig you out of a hole in several months, because it's always hard to dig someone out of a hole when they've run out of cash. Taking Malcolm's example, it's a lot easier to know you've got 3 or 4 months to plan. So look, we'll talk to people. One thing to say in particular, on the Irish side of the things, there is a lot of funding for hiring people like us. We're working a lot with the local enterprise offices. There's voucher schemes, and we're working a lot with Enterprise Ireland, who have a finance grant scheme, and they're effectively funding companies to hire us to do the forecasting. And you don't see that in the UK. But there's a lot of that for the on the Irish side of the border. If any of the members are looking at that.
Great. Well, that's something that we need to highlight really from an organisation point of view as we onboard members in Ireland. So that's very interesting to see that aspect.
Yeah. So always happy to talk, Paul, I guess is the message. And we'll take it with them. We talk to companies from early stage through to substantial and through to funders. Just I appreciate I'm coming to the end, but a funder at the moment is asking us to look at a business that is a bit more substantial, a bit complex. It's about a £40 million business. It's making £8-9 million a year, but it's got no cash, and nobody can understand why. So we're going in just for a project, just to look at that, and that's all we'll probably do for that company, unless we find anything else. The flip side is, I had a conversation earlier with a company that's early stage, starting a journey, not sure what to do, and they just need a few hours of guidance and not a lot of actual help from us, because we can coach them through some of the forecasting.
I think that goes to reinforce the point that the forecasts are the company's document. They're not just something that's prepared by an external and put on a shelf and rolled out once a year. They should be an embedded part of what a business does. And therefore, it's about helping the company prepare its forecast, but knowing that they take ownership of it, not just getting someone in externally to do a set of forecasts that looks very pretty and then never gets used again.
Fantastic. Well, listen, guys, thank you very much for the insight into forecasting. I think it's a valuable exercise listening to this podcast in particular, because I think we can't emphasize enough how important forecasting and the frequency that forecasting is looked at right now. So, you know, we're delighted to have you guys on board. I mean, for those of you who are listening, EFM have come into BITA and reshaped our finances and put us in, you know, in a lot better position during a very challenging and difficult time. So I would encourage all our members to certainly contact, you know, even if it's to have a chat, as Gary was saying, and speak more about their experiences and that of where experience can be shared, because that is in its essence the whole ethos of the ITA. So thank you very much, guys, for joining us. I'm sure we will have another session on a separate subject matter fairly soon, and we look forward to seeing you on the portal again.
Thank you.
Thanks, everyone.
Thank you.